So this afternoon, we're so pleased to recognize the first graduating class of Toronto Centre's Certified Financial Supervisors, or CFS, and to feature a fireside chat on the future of financial supervision. Toronto Centre CEO Babak Abbassadeh, unfortunately, is unable to join us this evening due to a family emergency, but he has asked me to convey his heartfelt congratulations to all of the graduates. Before I begin, if you'll indulge me, I'd like to take a few moments to introduce everyone to the important work of the Toronto Centre. Since 1998, Toronto Centre has provided high-quality capacity-building programs for central bankers and other financial regulators and supervisors, primarily in emerging markets and developing countries. With over 30,000 supervisors trained from 190 countries and territories, Toronto Centre's commitment to increasing the capacity of these public officials to build more stable and inclusive financial systems to promote responsible market development remains unwavered. The objectives of Toronto Centre mission are consistent with the priorities of the Financial Stability Board, standard setters including the Basel Committee of Banking Supervision, International Organization of Securities Commission, the International Association of Insurance Supervisors, the International Organization of Pension Supervisors, International Financial Consumer Protection Organization, and the UN 2030 Sustainable Development Goals. As everyone knows in this room, significant shifts in policy, including tariffs and foreign aid commitment, threaten to send waves of change through economic and financial markets. These developments, combined with ongoing challenges from climate change and technological disruption, underscore the critical importance of robust financial regulation and supervision. That's why, in our experience, leadership, good governance, crisis preparedness, and core supervisory skills is more crucial than ever. And the reason why Toronto Centre developed the Certified Financial Supervisor designation, a true Canadian-made innovation with global impact. Tonight, we're here to celebrate the 24 Certified Financial Supervisor, or CFS, graduates from Aruba, St. Martin, Curaçao, Bermuda, British Virgin Islands, Ghana, Jamaica, Nigeria, Paraguay, and South Africa. They're completing their financial program focusing on leadership this week. Most graduates began their rigorous designation, and in speaking with the graduates here, I understand it is quite rigorous. Is that a fair adjective? Okay. I just wanted to make sure. It was a rigorous designation started in 2022. And in fact, virtually, many of them virtually because it was COVID. So we're so grateful to celebrate their amazing accomplishments in person. I'm going to ask the graduates to please stand so we can acknowledge you and recognize you as the future leaders of financial supervision. Let's give them a round of applause, everybody. Thank you very much. As they say, it takes a village to raise a CFS program. And while we cannot thank everyone who was involved because there are just too many names behind this program, we would like to acknowledge two of our advisory board chairs who are in attendance, Clive Brio and Carl Herlau. Thank you. I also like to take this opportunity to thank Toronto Centre's founders, the Government of Canada, the World Bank Group, and the Schulich School of Business. As well, our current institutional funders, Global Affairs Canada, the Swedish International Development Cooperation Agency, and the International Monetary Fund. Without their support, this important event would not happen. Shortly, we'll begin our fireside chat, but before we hear from our distinguished speakers, I'd like to pass the podium to Donna Fuller-Barrett, Deputy Executive Director, Legal and Governance, Financial Services Commission of Jamaica, to formally welcome you on behalf of her class and to share a few reflections on the importance of CFS for the team. Please help me welcome Donna Fuller-Barrett, everyone.
Good afternoon, everyone. It is with great pleasure and pride that I deliver these remarks on behalf of the first graduating class of the Certified Financial Supervisor course. For each of us, after at least 6 flights, crossing seas and oceans over thousands of miles, 25 quizzes, I counted them, 5 exams, dozens of pre-course and in-course materials later, an arduous but nonetheless exciting journey, I feel that without reservation, we can say mission accomplished. I'm certain that I can speak for all of my colleagues across the globe in stating quite matter-of-factly that through this journey, we have experienced an undescribable exponential improvement in our core supervisory, crisis preparedness, and leadership skills, and are therefore better able to support the mission of the various financial agencies that we represent in a fast-paced and ever-changing financial services sector. Of course, by means of the program, we have been trained to identify barriers to regulatory and supervisory sound practices and are better equipped to determine appropriate responses. However, one of the undoubted value-added components is the networking opportunities that we have been presented with, as we all now have colleagues and resources to call upon for shared experiences and to call ourselves friends from literally all over the world. Very few programs have been able to accomplish this in such a short time span, whilst allowing participants the flexibility of still maintaining a semblance of normalcy in their family and work lives, and certainly this is worthy of an applause. It would be remiss of me not to comment on this week that has passed. Thus far, the training we have received took us through institutional frameworks and surveillance tools, capital analysis, cross-border cooperation, and relationships with non-regulated entities. At this final level, the leadership course gave insight into an area where supervisors often struggle. That is, addressing issues within the organizations that we serve and which are just as important as technical matters that we have to address. In varying degrees, we all face the same issues, ranging from weak legal mandates, institutional resistance, lack of support, and resource limitations. The shared experience across continents, coupled with the benefits of discussions in a safe and confidential environment, cannot be overstated. I also wish to use this opportunity to extend special thanks to the Toronto Centre team and to Toronto Centre founders. A warm thank you as well to Bill Routledge and Bill Coen for joining us today as we look forward to hearing your valuable insights. As the program continues, there is no doubt that the lessons learned will be implemented to secure an even better learning experience for those who will soon pursue the designation. Equally, there is no doubt that we have already and will continue to incorporate what we have learned to produce meaningful outcomes in our respective jurisdictions. Therefore, as we come to the end of this journey, we extend sincere gratitude to the Toronto Centre for its continued innovation, forward thought in enhancing its strong capacity-building experience to create a distinctive designation that the global supervisory and regulatory community can trust. Thank you.
Thank you very much, Danae. It's my pleasure now to introduce our Fireside Chat speakers. We're honored to hear from our distinguished expert, Peter Routledge, Superintendent of Financial Institutions, to help us make sense of this complex kaleidoscope of issues facing the financial sector and the resiliency required. Bill Coen, former Secretary General of the Basel Committee on Banking Supervision, will moderate the conversation, and we'll have time for some audience questions as well. And we encourage you to ask your questions. It's a great opportunity. We're fortunate that Peter's served on the Toronto Centre board and Bill is a current member on the board, and both are strong supporters of the CFS program. So ladies and gentlemen, please help me welcome to this floor, Peter and Bill.
Thank you. Good afternoon, Bill.
Peter, always a pleasure to see you.
Yeah.
This actually is a fireside chat. Well, there's no fire going, but it's good enough. Peter, I've got some questions here that I can throw at you, but we've known each other for some years.
Bill.
And
I'll pour you water while you do that.
thank you. So we can go through a couple of things that have come to mind, or we could just take it as it comes. Donia, you mentioned innovation. Someone else, Jerry, I guess it was you. You mentioned transformation. And really, these are transformational times. You've been around for a number of years, your incredible career, both public and private. I'd like to get your views on, I'd like to get your views on the future. But before we do that, I'd like to get your views on kind of where we've been. What is the expression? History doesn't repeat itself, but it often rhymes. Last couple of years, what have we seen? I mean, market volatility, contagion, current geopolitics, war around the world. What does it mean from it? So what have we learned in the last couple of years, or even as far back as the global financial crisis? And maybe more importantly, what does it mean from a supervisory perspective? What have we learned? What has OSFI learned?
I mean, to use another historical phrase, and I think I've said this at a couple of events recently, there are decades when nothing happens and weeks where decades happen. And particularly this year, but I would say going back even beyond this year, that's what it feels like. I started my career in 1990, and I remember those years, 89, 90, 91. And there used to be newspapers and boxes on the street. I don't know if you're old enough to remember that. But I remember walking down the street with my then fiancée, now wife, thinking, every time I read a newspaper box, it's just, I can't believe how incredible the headline is. That's what this period feels like now. I think we learned a few things. Most importantly, coming out of the financial crisis of 2008 and 9, we had this massive increase in financial system resilience through greater capital rules, greater liquidity rules, greater non-financial risk rules. And so let's look at the experience of this decade. We had a once-in-a-century global pandemic. We've had rising costs of climate change. We've had extraordinary innovation in the financial system. We've had a mini liquidity crisis in 2023, in which not only a few significantly sized U.S. regional banks failed, but a globally systemically important bank failed. And we've had a pretty dramatic shift in the global trade environment this year. Financial system's doing just fine. So everything we did and everything the students of the CFS program studied has been successful. The post-financial crisis experience is testament to the common sense, the good common sense of all the resilience building we've done over the last decade and a half. That's what I've really learned. Now, and we'll talk about the future, but complacency and overconfidence are your enemies as supervisors.
Yeah. All right, so let's look ahead. The CFS program celebrates supervisors who are prepared for the future. It's all about, leadership and what does the future hold. How do you see the role? I mean, given where we've been, where we are now, what we're experiencing, if you could, I don't know, pick a period, 10 years, over the next decade or so, how do you see the role of supervisors and your supervisory function? How does that evolve?
I'm going to give you some more standard technical answers to that question, but I'm going to start with a metaphor, a very simple metaphor. And I'm sure the students here are familiar with the character Superman, right? Y'all remember Superman?
Sure.
All right. That's not who you are, and that's not who I am. Who's Superman's on-earth ego or personality? What does he call himself when he's working at the Daily Planet? Anyone know?
Clark Kent.
Clark Kent. Clark Kent. Who's Clark Kent? He's very quiet. He's very smart, very principled. And when something's going wrong and his super senses pick it up, he's very quick to get on it, right? That's who you are. And I think of myself as sort of a Clark Kent. Maybe not everyone notices you or pays attention to you. You're not terribly boastful. At least I don't consider myself terribly boastful. But you're quietly alert, competent, principled. You snap to danger straight away, and you're alert enough to detect it early. That's what I think has been burned into you over your experience pursuing the CFS. Is that mentality? And so, looking over the next 10 years now into the technical part of the question, what do you need? Well, you need the core basics of, we supervise and regulate highly levered financial institutions, right? In our system, the gross leverage ratio on average is about 4.25%. I mean, the banks are all levered here, 25 to 1. I mean, if their assets lose 4% of their value, you got a problem. So that's why you need Clark Kent, super alert, super quick to act on the job. And so you need to understand, core capital, core liquidity. That's your core bread and butter, what you do. And in Canada, we call it integrity and security, but another word for it is non-financial risk. And so that's just an additional layer of complexity. You have to understand cyber risk. You have to understand, are the institutions that are in your system, they understand the importance of having a good patch management system for software updates. And if they don't, what is the destructive potential of that? Well, cyber criminal can get in and abscond with customer data or lock down information systems. You have to understand that. You have to understand third party. What if that happens at a third party that a financial institution is relying on? What happens with your the governance at your financial institution's board of directors? Are they really asking smart, incisive, pain in the neck questions Bill and I were talking about? Or do they show up once every 3 months and clap for the CEO? Well done, sir. Another great year, right? You need to be on tune with that risk. And then, holy cow, digitalization. And the distributed ledger and the digitalization of financial services together are going to transform business models in ways we don't understand yet. And you're going to have to, in 10 years, you will understand that a lot better. The course of financial system innovation is not smooth. And the financial crisis of 2008 and 2009 illustrate this. You had an amazing innovation in securitization. And that innovation was by and large outside the financial system with critical connectivity to it via how the banks were funding these innovative structures. Probably something similar is going to happen over the next decade. Digitalization is going to create risks that we don't yet see. And when those risks materialize, the costs will be acute and concentrated in specific areas. And again, we're going to have to be alert and quick to where the danger is.
I like the way you structured, Peter. You started with the nuts and bolts,
Yeah.
the basics, the fundamentals. And I think that's something that came up Toronto Center board meetings, the importance of getting, that foundation set. But then on top of that added layer of complexity. And you saved the best to last, the digitalization. This is something that I know a lot of regulatory authorities around the world, they kick around. What should be the role? Is there a role for the supervisor in facilitating, promoting innovation?
We're thinking about that a lot. And a cultural mindset that would detract from our overall mission, in my view, is risk aversion to innovation. We erect high barriers to innovation. We make it hard for non-traditional players to jump into the system to compete with traditional players. What we want as supervisors is financial resilience that serves the interests of creditors and depositors and policyholders. We're not going to get there if we keep the innovation outside the system. We need to be focused on is driving down the disincentives to joining the regulated system. I was meeting with an innovator today, and I'd through some channels I'd connected with him, and we had our first call, and I went right to the point. I said, "How can I sell you on the merits of joining the federal financial system regulated by OSFI?" And then we began a conversation over how difficult it is to get into the system and what we at OSFI could do to make it less difficult. And so the mindset towards innovation should be, how do we drive down disincentives or barriers to innovators choosing to be regulated by financial system regulators? If we do that, the innovation will occur within the system, and there's higher likelihood that we will avoid an unnecessary buildup in risk concentrations that can undermine confidence in the overall financial system.
So let me take it a step further and maybe push back a little bit. Play devil's advocate. So supervisors now have the challenge of understanding the basics: credit risk, market risk, operational resilience. But as you put it before, there's this layer of complexity on top. Now, there is and I agree with you. I think you're absolutely right. There is a role for supervisors. You think of sandboxes and promoting that. The innovation. Times are changing, and it's a competitive business. And financial institutions, they have to change. They have to keep current. They have to innovate. What is the risk, though, that it detracts from the broader set of responsibilities? Prudential safety and soundness, consumer protection, even more broader financial system stability. How do you get around that? I mean, so I think, Donya, in your comments, you mentioned I think every organization represented in this room has budget issues. That's a constant throughout the official sector. So all of these things, Peter, that you mentioned, and I agree with everything you said. How do you square that circle with the additional role for innovation, and how do you get it to not impinge upon those other historic traditional responsibilities?
Well, the honest answer is I'm still trying to figure that out.
Oh.
A more thoughtful answer is you need to recognize just philosophically that as Joseph Schumpeter talks about, creative destruction in an economy is healthy for an economy. Creative destruction in our system means innovators enter your system and 9 out of 10 of them fail. And the one that succeeds causes a traditional competitor to fail. And supervisors are allergic by virtue of the role they play. They tend to be allergic to institutional failure. All right. I know the story of one of my predecessors in one of his meetings with the central bank governor at the end of his first meeting after this person got the job, and the governor looks at this person and says, congratulations, your job you're doing is very important. Thank you for doing it. And you do know you're there to take the blame if the bank fails.
Great.
And I think there was some jest to that comment. I take it seriously, not literally, but I do think that is reflective of this expectation and culture within supervisors. It's your fault if an institution gets into trouble. And I'm here to tell you it's not your fault. It isn't. Institutions have senior managers who are very well paid. They have boards of directors who are also very well paid. And they're entrusted by their shareholders to create value for their shareholders and to create value for other stakeholders like creditors and depositors, customers, etc. When the institution fails, that's where the accountability lies. Now, it doesn't mean, by the way, that you don't have responsibility. But if you adopt a mindset that I'm responsible overall for systemic stability, and that starts with institutional stability, and I'm a force for long-term resilience in the financial system, but I know where ultimate accountability lies, then you're opening yourself up to creative destruction. Then you can say to an innovator, come on into my system. I'll lower the process and the barriers and the costs it takes to enter our system. And if you fail, I'll make sure the failure is quick and inexpensive. That's what you have to embrace as a regulator. And it is countercultural. Your media, whether it's mainstream or social, your broader array of partners in your financial system, at central banks and consumer protection and deposit insurers, etc. They don't want, and by the way, the broader public and elected officials and other government officials, they don't want failure. And you'll feel the pressure to give them a perfect record. And when you do that, you will drive down broader resilience in the long term, broader resilience and productive growth in your country. And that's why what you do is so important. And learn. There are three mentalities towards risk: risk-seeking behavior, risk-averse behavior, and risk-intelligent behavior. Risk-seeking behavior is taking wild risks for low return. Risk aversion is avoiding all risk, driving it to zero. Risk intelligent is saying, I'll take that risk because that potential benefit is worth it. And I know I'm not going to get every risk right, but if I get 6 out of 10, we're good to go.
We were talking earlier, Peter, about some changes that you're making in OSFI, the rating system. And I was thinking, so from a leadership position, and you're the head of the organization now. You're the head of OSFI. You've had leadership positions in the past. How much scope for flexibility and creativity do you have? Bank supervision, bank regulation, well-established norms and expectations. But, we've been talking the last few minutes about innovation and transformation. You've got to change with the times. In your position, how much scope do you have for making changes?
So there are two levels to the answer. At the institution-specific answer, so how, as a supervisor, you're relating to individual institutions in your system, you have very little scope because everyone expects to be treated exactly the same. And everyone expects consistent, proportionate supervision and regulation. And so I find myself occasionally defending a common standard, even though it seems a little bit out of place for a particular institution. But the importance of a common standard that everyone knows everyone else is subject to trumps sometimes the idiosyncratic inefficiencies. That's where, and that conservatism can grate and be irritating, but there is this broader game you're playing, which is confidence that your regulated constituents feel like they're treated in a consistent way. And they all talk to each other and they all tell each other what they're not supposed to, which, when you say, hey, I'm going to give you this treatment or this, I have this judgment about your institution and it's confidential, don't tell anyone. They tell everyone. So, which you don't complain about, you embrace. It's like, okay, that means I have to be that much more consistent across the system. So when they do that, they feel very fairly treated, even if they disagree with your conservatism. And then there's the broader piece, which is how you're navigating your regulation within a rapidly changing, transforming environment. And in that, I'd say be creative. And, in our first couple of years, when I began to serve as superintendent, we drove up capital buffers. We drove up liquidity buffers. We drove up integrity and security or non-financial risk buffers. Because at that particular time, coming out of the COVID era, the economy still booming, and particularly the banking system still booming. We thought now's the time to buy insurance because it was cheap. Well, now we've done a bit of a 180, and now we're talking about come to us with ideas for smart deregulation. And the trade-offs we're trying to make are we'll give up very little in terms of financial resilience for gains in terms of growth and expansion. And that is the intent. Very different where we were 2 years ago, but that's where you have flexibility.
So on this subject of regulation or deregulation, so much has been done over the course of years, particularly since the global financial crisis. In Canada and other members of the Basel Committee have, for the most part, put in place the Basel III rules. So my personal view from a regulatory side, there's not so much that needs to be done. It would be helpful if your neighbor to the south put the rules in place and finalize them. If you agree with that, not much needs to be done on the regulatory side. But on the supervisory side, you've mentioned operational resilience. Mm-hmm. I've had conversations with one of your deputies, Ben Gully, about operational resilience. You mentioned cybersecurity. What is your main recommendation to the firms that for which you have oversight authority, and your staff? What do you look for? How do you promote? How do you really improve and excel at operational resilience if you're a bank or if you're a supervisor with the oversight task?
Try and scare 'em.
Yeah, I mean, again, Peter, in this complex, increasingly complex environment, so
you find cases that are frightening.
Mm.
You find cases where a system outage impairs access to financial institution services for an extended period of time, and you discuss the damage that does to that institution's reputation. And there are examples of that abroad and here in Canada. And I've said this a few times publicly now. In this broader environment, very rapidly shifting geopolitics, the era of free trade is over. The era of a benign international environment where we all share the same values is gone. And a new era is arriving, and there's more geopolitical conflict in that era. And sometimes it's kinetic, and Ukraine, Middle East would be two examples of kinetic conflict. And sometimes it's virtual or cyber-based, and all the attacks in in cyberspace are an example of that. And so what we say to institutions is, you're innocent bystanders in a theater of conflict. Build up your defenses, because even if you do everything right, some nefarious actor may still attack your organization. And by the way, certainly that'll harm creditors who, as a supervisor, we're meant to protect, but it'll harm your shareholders as well. And they know this implicitly because they're getting reports on cyber attacks, and they're getting reports on anti-money laundering, or rather money laundering attacks, for which anti-money laundering defenses might not have been adequate. And whether your cyber defenses or your anti-money laundering defenses or other defenses are adequate or inadequate doesn't make your institution good or bad. Your institution, this is where my message to institutions, our system, you're trying to provide a high value service to your customers, create value for your shareholders, make sure your employees have a good place to work, right? That's the magic of an institution in a capitalist system. If you don't build those defenses up, you're going to destroy that, or you put that at risk. So find a way to put up defenses. And as a regulator, because you're talking to everyone in the system, you can, without violating confidential information about your financial institutions, promulgate best practices. So if you look at OSFI's cyber risk guideline, our third-party risk guideline, our operational risk guideline, our model risk guideline, our corporate governance advisories, we're just propagating best practice. And then once you have those practices propagated, then through the supervisory function, you can begin to provide messages to boards and senior managers where they're light, and you can make that a supervisory focus.
I like how you start off by saying you scare people, and there are no shortage of examples these days of what has gone wrong. Silicon Valley Bank was not too long ago. We hear cyber security issues all the time, and so don't let this happen to you. Peter, if it's okay, I'm going to open the floor in a moment to see if we've got some questions from our colleagues. Before I do, we've got the CFS graduates. They are already in a leadership position. I'm most confident they will continue in that position and grow. They'll have an increasingly senior role in their organizations. Any advice?
Yeah. Well, you got my Superman metaphor, my Clark Kent metaphor. So keep that in mind.
I like that.
My advice is centered around the core values that we're trying to build around at OSFI, and we call it grit, urgency, and integrity. Grit, urgency, and integrity. Grit is take a punch, fall down, get back up, take another punch, fall down, get back up, take another punch, fall down, get back up. Keep going, never give up. Your failures and your mistakes are your badges of honor. Just keep going. And by the way, you're in supervision, you're expected to be perfect, and you can't be. So you're going to get plenty of knocks. And we and I at OSFI have got plenty of knocks in the last 4 or 5 years, and you just keep going. That's grit. That, by the way, is more in research that I've seen, that quality, grit, is more determinant of success than intelligence.
Great.
That's what you need, and you can control that. And what grit gives you is like the whole notion around intelligence is sort of based around this notion, you're born with these qualities, you can never change them. And that's garbage. Okay. Grit is, I'm born with certain strengths and weaknesses, but by doing things with trial and error, I'm going to improve my strengths and lessen my weaknesses, and never give up on that part. The urgency is do it now. There isn't never in my time as superintendent have I thought, I acted too early. If only I'd waited a day or two to make that decision. I have never, ever said that. Urgency is do it now. Even if you make a mistake, that mistake you make and what you learn from it will be more valuable than waiting. Do it now, do it now, do it now. And in financial institutions that are highly levered with 4 or 5% leverage ratios, do it now is, the stakes of waiting an extra day can be pretty high. So do it now. And integrity, that gets back to the Clark Kent metaphor. Do what everyone in the room will think is the right thing to do, even though they're not watching you. Take the hard decision, endure the complaints of your regulated constituents, because sometimes you're giving them bad news. Because financial systems are interconnected, and one bad apple could spoil the bunch. So do the right thing when no one's watching. Hold to your principles. Make sure you're holding to principles, and try and have a flexibility to see your principles not as rules, but as principles to be strived towards. Hold that sense of doing right. And I think that is the harder path, but it's the more rewarding, successful path.
Excellent. Grit, urgency, and integrity. Well said. Thank you. Ladies and gentlemen, any questions for Peter Routledge, Superintendent of OSFI? Yes, please.
All right. Hi, Peter.
Jeremy?
Just a quick question on the innovation stability dynamic. How much of it, in terms of allowing more innovation, is when you have a system that can contain failure, right? It can, contain it to one institution and not have it spread, not have that kind of contagion, because then you can allow more of that innovation to occur. And how potentially hamstrung is Canada, where we have sort of the dominance of big players?
A predominance of, sorry?
Big players, bigger players.
Well, the predominance of big, healthy players gives us a unintended byproduct or consequence, which is we haven't had a retail deposit institution fail since 1996. We're coming on the 30-year anniversary. It's a bug, not a feature. So to be honest, the straight answer to your question is if an institution, a deposit-taking institution, were to fail, that would be the teachable moment where we could demonstrate that the system could absorb that and keep going. We have a very profitable, well-capitalized, healthy liquidity levels in our banking system, and the probability of a failure is still quite low. If we invite innovation and innovators into our system, the probability will rise, and I would welcome that. But there isn't a magic wand. How do you make the system ready for it? The truth is, the system needs a teachable moment, and when it arrives, and I won't wish for it or fear it. When it arrives, we'll treat it as an opportunity to teach the system. Yep, Canadian institutions can fail, and the system will absorb it and keep going.
Good. Thank you.
Peter. Hey, Darren.
Next.
There was
Please.
a piece in the FT earlier this week with Andrew Bailey, and he was talking about his growing concern with the amount of risk buildup in the private credit market, with some of the things that have wobbled in the U.S. in particular. Do you share his concern, and what does that mean for you as a supervisor of the regulated space with entities, in that case, that are outside of your remit?
So, Governor Bailey, he and I think in that appearance at the UK House of Lords, he used the phrase or the metaphor, canaries in a coal mine. Is it a canary in a coal mine? And we don't really know. I mean, time will tell. My sense is, in part, and if there's a question about how we need to think about bank capital after this, I'd be happy to answer it. But in part, more resilience, building more resilience in the system through capital rules has pushed some lending outside the banking system, right? And there has been fast credit growth in that part of the financial ecosystem. And that growth probably has some unanticipated credit loss in it. Is it just a canary and that's it, or is it a canary in a coal mine and we don't know. My sense is so far, the private credit system, I don't want to over exaggerate, but its funding model is longer dated than a banking system. Banking system is based on deposits and anywhere from overnight to like 5 years, right? And so when you get credit loss suddenly in a banking system, that funding can disappear, and then all of a sudden you're faced with, I got to sell these assets because I got to pay back my depositors who want their money back, right? It's a wonderful life scenario. Private credit system, the funding they have, a lot of it is institutional or high net worth money, and they expect their money to be locked up for a period of time. And so the liquidity hitch, it's unclear to me it's really going to create a crisis. It is quite likely that credit losses are going to be higher than folks would hope for. And that's part of the credit cycle. But I haven't seen evidence that there's going to be a liquidity blowback. If I'm wrong about, or if that optimistic take is wrong, it'll probably come in the connectivity between the banking system and private credit. And the financial system, the banking system, does provide shorter-term demand funding to private credit. And if the banks get nervous and call those that form of leverage, then there could be a worse problem than we would hope for. But time will tell.
Thank you. Young lady up here, please. Oh, thank you, Jerry.
Hi, Peter. My name is Tshegofatso Mudau, and I'm from South Africa. But don't worry, I can teach you how to pronounce my name after this. If there's anything you're going to learn from me, it's how to pronounce my name. So my question is linked to the question that Bill asked you earlier on, and it's about finding the balance between resilience and innovation. I just want to understand, in your view, how do you define resilience in the context of a fast-changing world, and particularly in instances where you find that there's more risk that are emerging and newer, and some of them are more prevalent in other jurisdictions than the others. So how do you balance the two in different jurisdictions where you're trying to promote innovation as well as stabilize the economy and some growth in that? Thanks.
Resilience is just the ability, in my mind, it's the ability to take a punch. So you could define it as, I would say the Silicon Valley Bank experience is an example of the resilience of the U.S. banking system. It was it's about $200 billion bank, and it failed in 36 hours. The system's fine. There wasn't a recession. There were a few other institutions that had similar funding models that struggled, right? But basically, the U.S. banking system sailed through that, right? Admirably. I mean, good work to the financial supervisors in that system for building that resilience. That's an example of it. Here in Canada, another example of resilience is around the whole climate issue. And in Canada, climate, the costs of climate change, the physical risks of climate change, are not now a financial stability risk. Now, those risks and those costs are rising in a nonlinear way. So resilience to me in that context is ensuring our institutions are building capability to measure that risk, price it into their capital allocation decisions. And I think if we do that well, they'll make smart decisions by and large. And the system and institutions within it will be more resilient as that cost curve continues to grow exponentially. To give you an example, we did this research in a study and published into climate scenarios. And we found, as part of that study, 75% property and casualty insurers use geolocation mapping, latitude and longitude, to understand where your collateral is, to price their climate risk. And they take and lay off risks based on that very, very granular, rigorous work. Only 12% of banks do that. Think about that for a minute. Well, P&C insurers are much closer to the risk, so they're developing the technical skills to do that, to price it more effectively. And they've done it. 3 out of 4 of them have done it. Meanwhile, only 12% of banks have done it. So we do that work, we propagate that knowledge, and by virtue of me saying this publicly and us publishing it, we're hoping that bank boards go, hey, wait a second. Are we doing geolocation mapping on all our collateral in our housing loans, in our commercial real estate loans, and our other business loans that are collateralized by property? Maybe we should start doing that. There's plenty of geolocation coding software out there that any financial institution to use. Boards of directors should be asking, are you doing that? To their senior managers. And when they say no, they say, do that. That's good supervision. That's propagating best practice quietly. No one sees, no one's going to give you credit. But, hopefully in 5-10 years, if, as I believe likely, costs of global warming hit our economy more severely, our financial system will be resilient to it. You have a follow-up.
Yeah, so just on that point on climate, so would you then still in your opinion rather build up some in the Pillar 1 framework, have some sort of capital add-on for climate risk, or would it still want to see it under the Pillar 2 framework, under the supervisory review and discretion of the supervisor?
It's too early to answer that yes. My own thesis going into that, and I wouldn't rule it out, but my own thesis going into it is if we get widespread measurement of both physical and transition risk done at the institution level, and that flows up to boards of directors, and the issue is front and center and empirically observable, that capital will take care of itself, that institutions will look at their PDs and their LGDs and they'll make common sense adjustments to it. Now, they may need help from us. We may have to do something to help that along. But my sense is if you just empirically measure the risk, and that's what I mean by pricing the risk, then senior managers and boards will make intelligent decisions. That's the beauty of a market-based system. The beauty is when you get empirical data up, responsible people make smart risk-return decisions.
You know what?
Are we out of time?
One more, please. Please, Peter. Sorry about that.
All right. Good afternoon, everyone. Dwight Hamilton from Jamaica. And I must say it's a privilege and an honor to be here.
Likewise.
From the first time I walked into the regulator, we have been looking at what OSFI does and what Canada does. And you guys are one of the countries that we look to for guidance. So it's really an honor to be here. My question is for good capital, especially for financial conglomerate, those that include insurance, banks, and securities dealer. Are there any progress being made in developing capital standards for the group and liquidity standards for the group? I know there have been talk about capital buffer, liquidity buffer, but I just wanted to know what you could share about that.
So for a group, are you talking about specifically insurers or all financial institutions?
A group that has banks, securities, and insurance all together, life, general, because it's more complicated, I think, when we have an institution like that.
So I would say with banks and insurers, we're pretty strong on that. So if a bank owns an insurer, we will measure the capital liquidity characteristics of the insurance entity and as well as of the total bank. I think we're okay on that. I think if it's a group, a parent institution that owns foreign subsidiaries, and the foreign subsidiaries have a host regulator. I'm the home regulator. We've figured out how to make sure capital is reasonably available both for the subsidiary and the parent organization. Where we have work to do is really in the securities space. And in Canada, there isn't a national securities regulator, and OSFI isn't a securities regulator. However, the banks that we supervise have about 85 to 90% of the securities market. And so where we have done work is in market risk, liquidity risk, and an emerging area. And it's related to the non-bank financial institutions. We need to make sure our banks, through their securities arms, are managing their exposure to non-bank financial institutions more carefully. And the way we are going to do that is through the Financial Stability Board guidance and recommendations on sound practices for measuring and managing counterparty relationships in terms of the leverage the non-bank financial institutions have and in terms of their liquidity preparedness for margin calls and other funding calls. And if we can take those advisory documents and build them into our credit risk management system, then I think we're moving the ball forward on the securities piece.
Peter, thank you very much. And I apologize for those of you who had questions. We have run out of time. This has gone very quickly. I love the Clark Kent metaphor. I like what you had to say about learning the basics, understanding the nuts and bolts, the foundation of risk and supervisory oversight. I particularly like the grit, urgency, and integrity. And that made it come full circle back to Clark Kent. Before we finish for the evening, Peter, I wanted everyone here to know OSFI for many years has played a really a pivotal role in the governance, the stewardship, the strategic direction of the Toronto Centre. Without the generosity of Global Affairs Canada, without the involvement of OSFI, the Toronto Centre could not do what it does. So, Peter, on behalf of the Board of Directors, I want to thank you sincerely. Thank you very much.
Thank you.
Thank you again.
All right, thanks.